Okay. Good morning. Welcome to our panel on investing in renewable energies. Today we have an opportunity to discuss with our panelists renewable energies as an investment theme. I would like to start with welcoming our three panelists. Aanand, he leads the development and growth of the ETF business at Legal and General Investment Management, one of Europe's largest asset managers, catering to all client segments.
Hello.
Kilian, hello to you as well. Kilian is a client portfolio manager on the global equities team at RBC Global Asset Management in London, focusing on institutional clients and banks and investing in selected listed equity with large minority stakes, which allows them to engage with management.
Welcome.
Warm welcome as well to Michael. He heads the AMCs and thematics at Vontobel Wealth Management. He is distributing the strategies to external asset managers and private client relationship managers in Switzerland. Among others, focus recently is on disruptive technologies and sustainable strategies.
Yeah, thank you very much. Just a side note, before we start the official part, I think the title here you can see on the screen is a bit to confuse you all, but nevertheless, I think what you said is the right function I do have within Vontobel.
Excellent. So maybe let's start with the first question, a very general one. Maybe let's start with Kilian.
Sure.
How can the investment theme, renewable energies, be implemented in your client's portfolio at RBC?
Sure, and thank you very much indeed for this very kind introduction, Christoph. Well, look, I think we have to take a step back here first. I think we all on this panel can agree that the investment opportunity in renewables is huge, that the political will and intentions in most countries around the world are huge, especially after Russia's invasion of Ukraine and the challenges around energy security and supply that we all experienced here on the continent during the winter. That clearly magnified the opportunity. However, and we as fundamental bottom-up active stock pickers shall not forget that there are also challenges, especially around the affordability and the willingness of the consumer to pay for all of that. So for instance, we saw metal pricing surging over the last couple of years, especially copper, which is a key metal in order to reach net zero, in order to decarbonize the world. We also see labor shortages, especially for qualified engineers in order to build these renewable projects. And again, the question around the affordability. So this really brings us back to the energy trifecta of security, affordability, and sustainability. And the big question for us as investors is, and this pretty much goes back to your initial question, how can we best play the theme? And this is much bigger, much broader than just renewables. There are also opportunities in, for instance, companies which are in a transition phase, for manufacturers, for equipment companies, for commodity companies that deliver the raw materials needed. And how do we invest now in and play this theme? I just would like to highlight a few companies that we own, for instance. And Christoph, you mentioned in your introduction very kindly, we do manage in our strategy 30 billion, have a very concentrated approach of only 26 stocks. So we tend to be one of the largest institutional shareholders. So we have very good access to the management teams, to the CEOs and CFOs of the businesses, so the key decision makers. We have one-on-ones with them and can engage, for instance, on the CapEx spending. So one of the companies we own is Equinor, and the Norwegian-based energy company. And now some of you might argue, hold on a second, Equinor, very much known for being a natural gas company. And while I do have a certain degree of sympathy with this argument, investing is all about the future, isn't it? And the CapEx spending is very much dedicated towards renewables. By 2025, so in just 2 years, 30% of the CapEx will be dedicated towards renewables. So over the last 6 years, Equinor spent 23 billion dedicated towards renewables. By 2030, that share will go up to 50%, and in 2050, aligned with the Paris target to limit global warming to 1.5 degrees, Equinor will be a net zero company. So this is my dear friends, how you can really create impact by helping and enabling a fossil fuel company of today to transition to a fully renewable company. And the last thing I would like to highlight is First Quantum Minerals. It's a Canadian-based copper miner that we do own, and copper is a key metal in order to electrify the world. If we speak about renewable energy, we speak about electrifying the world. And you can't build a wind park, you can't build a solar farm, you can't build batteries, electric vehicles, or whatsoever without copper. So it's a key enabler for this journey. Or if you think about semiconductors, there is no electrification, so no renewable energy as a power source without these little microchips. So there are multiple ways of playing the theme, and I think this is really important to highlight, and one shall not forget, we have to ask ourselves when we speak about renewables, where in the value chain we can make money off.
Thank you very much, Kilian. And maybe Aanand, also from your side, the same question. How do you implement in your clients' portfolios the investment theme, renewable energies?
Yeah, sure. Thanks for asking that question, and thanks for that response, Kilian. So the way we look at it, I mean, we split the green landscape into 3 funds. One is the production of power, that's renewable energy. Second is related to storage, which is battery value chain. And third would be newer forms of energy, clean energy, which would be green hydrogen, right? And across these funds, we manage about just under $2 billion across these 3 ETFs. But when it comes to clean energy, I go along with what Kilian said. It's very difficult to convince someone to adopt a product or solution if it's more expensive than what you currently use, right? Thankfully, when it comes to renewable energy, and we are at a very critical point of time, because just a few days ago, there was a news article that said EU produced more power from wind and solar than from nat gas last year. So wind and solar made about 22% of EU's production mix last year when compared to gas, which was about 20%, right? Why is that happening? Clearly because of economics, right? I'm a firm believer in economics. So today, wind and solar is the cheapest form of power anywhere in the world, cheaper than coal. So you don't need to incentivize anyone to actually go and build a solar or a wind farm. It's much quicker to build a solar farm than building any other facilities, right? It takes about 3 to 8 years to build a coal facility. You can build a gigawatt of solar in 6 months if you really want, right? It's about sticking the panels and supplying the power. So those kind of fundamental shifts has kind of really changed the way we think about clean power, where you don't need to artificially create demand or sort of, the tailwinds by incentivizing, by providing the tax incentives and things like that. But the economics is so attractive. So on the power generation side, we look at the entire value chain, right from service providers, component suppliers, the likes of people who manufacture inverters, electric cables and conductors, through to the OEMs, to the wind turbine manufacturers and solar module manufacturers. But we don't stop there. We go another step deeper to say, who's manufacturing the wind turbine blades? So who's actually innovating those composite materials, like TPI composites, for instance, who make these really agile, long-lasting, durable materials for blades? Who's manufacturing the generators? Who's doing the switch gears? Who's doing the gearboxes that go into the wind turbines and so on, right? So we go deep into that upstream component suppliers, the OEMs doing the turbines and modules, and the utility companies and independent power producers who are kind of literally making up the backbone. And within battery value chain, we look at companies that own their own battery technology and who manufacture batteries. To give you an example, there are more than 300 companies doing EVs just in China alone, but less than 20 companies who manufacture batteries, right? So we don't look for the chassis builders, but we look for the technology owners who have their own battery chemistries. Then we look for lithium miners as well, just like what Kilian mentioned about copper, but we look for lithium in battery value chain. And in the hydrogen economy, of course, we've got different subsegments across the value chain that we track. So overall, split across 3 different funds, each focused on its own sort of niche verticals, but essentially looking at a more broad, diversified, but still a focused basket. And one point that I wanted to make, when it comes to sort of offering these exposures, even though we wrap it under an ETF, our approach that drives the stock selection is one that blends active research and actively designed investment strategies. So it's not a passive play at all. There's a lot of data, structuring, data cleaning work. There's a lot of research, bottom-up, evidence-based research that we rely on, and we design our investment strategies ourselves and kind of let them evolve as the theme evolves over time.
Thank you. Thank you, Aanand. And maybe Michael, the same question. So how do your clients invest in renewable energies?
Yeah, very good point, and I will try to make it a bit shorter. So, talking from this Vontobel perspective, we have on the one hand side our OSC individuals, and here our primary offer is our ESG advisory, which is based on our in-house analysts we do have. Then on the other side of the spectrum, we have our asset management within Vontobel, and here we have different fund solutions available. For example, our clean tech fund, which is certainly the biggest, our flagship product when it comes to renewable energy, but also very interesting is our energy revolution fund, which basically covers all different segments of the market, from hydro towards sun and wind energy and all this, what is in between. And then the most interesting, and this is the area which I'm heading within Vontobel, is the distribution of thematic investments. And the beauty of thematic investments is that you can really play decent niche themes, because with the certificate solutions we do have, you can start investing from a portfolio perspective of 5 million, let's say, and you can really go deep into this universe. So for example, we have dedicated strategies which focuses only on solar strategy. We have wind, for example. We also have hydrogen. So we have multiple different strategies which cover the renewable energy. And it's really tilted towards the needs of the individual clients we do have.
Thank you, Michael. Maybe also from your side, any examples, any success stories, what went very well when investing in renewable energies in the past, and also maybe addressing at the same time like the most difficult challenges that you have identified?
Well, investing in thematic investments or with thematic investments is always about timing. And the beauty when you choose investment vehicles, which are certificates, is that you are very fast at the market. So as soon as a new trend appears, you need only a couple of weeks to structure a new certificate, based, of course, on the in-house capabilities we do have in investment research. And one of the examples we do have, which is one of the most successful products we have launched over the last couple of years, was the so-called hydrogen index, which I think we launched in spring 2020, which was when this topic popped up, everybody was talking about hydrogen. It was quite successful in terms of raising money. And more important, it was even more successful in the performance we have or we could show to our investors. On the negative side, or on the downside, I would say quite recently, is that there is kind of, the market is not really keen on new sustainable investment solutions. So basically everything which is related to ESG, or more on the E in the ESG, is that clients are not really seeing the need to invest further into this topic. So there's really a slowdown in client demand, and this is something which really keeps us awake at night. Interesting.
Thank you very much, Michael. Kilian, you already mentioned two success stories from your portfolio.
Indeed.
What are the limitations or challenges that you see when investing in renewable energies as a RBC Global Asset Management?
Oh gosh. Well, I would probably say, and you also addressed in your questions probably the last year in particular, I think one of the challenges we faced as investors were the valuations levels that went up to unsustainable level, in my view. If you take, for instance, an Ørsted, the Danish wind farm operator, or Neste, the Finnish-based biofuel company, too much money was chasing the same sort of investment themes over the last couple of years. So some of these stocks were last year down 50%. So I think we as investors should be very careful not to be thematic investors, but rather focus on investment themes, or not themes, investment opportunities that generate long-term sustainable returns for us. And I think if too much people are trying to chase the same theme, this creates bubbles, and I think this is what we have seen over the last year. And what I will also say is that historically, the developer, like the Ørsteds, for instance, of the world, have been a very good area to make money, pretty much for multiple years. And the manufacturer has not been such a such a good part to be in, because the developer, they really squeezed down the cost and the supply chain, and with raw material prices only coming down, it was a really attractive part to be in. However, we would argue we might be at a tipping point where the balance of power is actually changing from the developer towards the manufacturer. And I think this is something we have to be very, very careful of. And this is something where we as deep fundamental investors are spending currently a lot of our time and efforts on.
Thank you very much. Aanand, what would you like to add?
I would say, I mean, for us, I mean, we were thankfully lucky on the valuation side because we focus on multiple segments across the value chain. So even if certain sub-segments were overvalued, few others kind of overall brought that average PEs down. So in that sense, we were fairly lucky when compared to some of the other competitor funds. But because we do track a number of large sub-segments which we deem critical to the whole clean energy value chain, each one has different challenges. You know, for instance, if you take a utility company, there are weather-related challenges. If you take RWE, they had drawdowns a couple of years ago because of the Texas deep freeze. Uniper because of the Russia war, right? So there are those type of idiosyncrasies. Now, when you take wind turbine manufacturers, the margins are super volatile around raw material prices. So how do you actually pick companies that are dominant players that have enough capacity to sort of withstand that potential market volatility, right? Again, within battery value chain or lithium providers, right? So it's a question of how do you identify companies who are mining lithium that primarily go into making batteries and not into, I would say, making pharmaceutical drugs and things like that, right? So it's those type of challenges that you have to deal with. But increasingly, what we are also facing as the whole ESG narrative gets more popularity is the lack of understanding in the general market around why some of the legacy players who have some amount of fossil fuel exposure or expertise are relevant for the transition. I'll give you an example. If you want to kind of go and stick turbines offshore, you need wind vessels, basically, vessels who can go and do the EPC work about a mile or two out in the ocean. But who has the expertise right now? It's the people who actually did that exploration work for oil and gas company, right? So if you end up including those stocks, it is kind of seen from a negative perspective because they still have some exposure to oil and gas, right? But you need those companies for the transition. And the same with some of the examples that but Kilian mentioned as well. So if you take Equinor, Uniper, and so on, see, these are gas majors, but gas is an important transition fuel. So it is taking some time to educate the press friends in the media world, and again, some of the investor community as well, to drive across that importance that we need with some of these people who own the expertise, but who are linked to the, I would say, more conventional sources of fuel.
Thank you very much for this. And maybe a follow-up question. So financially, like looking at renewable energies, often when we talk about renewable energies, we think of climate change. So when an investor wants to fight climate change, but also generate attractive returns, what would be for you like the number one opportunity that we're looking at today in terms of technology and positioning within the supply chain, considering both developers, manufacturers, distributors? Where do you see now kind of an investment opportunity?
Yeah, I mean, to sum it up in one word for us, it's about enablers, right? Companies that are going to enable this transition, companies that are innovating in this space, be it in renewable tech, battery storage, better energy management, or hydrogen technology in the form of electrolyzers or fuel cells. Who are those who are owning that technology? And we go hunting for those companies, really. Yeah.
Thank you. Michael, what investment theme do you think is most attractive in terms of financial returns right now?
Well, I think there's not this one-fits-all solution. It really depends on the view of the individual investor. I mean, there might be one client outside who is very keen on investing in electric vehicles because he sees, okay, all this dirt, all those combustion engines in the cities, for example. Zurich is not the perfect example, but if you go to London, if you go to Paris, if you go to Berlin, it's quite a lot going around, right? So this might be an interesting investment theme, electric vehicles. And there are other investors who want to invest into battery energy storage, because this is one of the sources which is needed. Of course, we have a lot of renewable energy, but this renewable energy must be stored somehow. Then this investor might think about battery energy storage. Another investor might think, okay, how does this renewable energy, for example, is transported within Germany, as a good example, from the northern part to the southern part. So, and here we have another solution which is called the Smart Grid Index. So it's really based on the idea of the individual investor and really where he sees the biggest opportunity. But to pick one, I think what I still prefer at the moment and which we recommend to our wealth management clients is certainly everything which is related to hydrogen. It's still a growth topic. Of course, it corrected quite substantially after this decent rally we have seen in 2021, but I think for new investors, I think that might be an interesting opportunity.
Thank you very much. Michael, Kilian, would you like to add anything to that?
Yeah, sure. I think the first thing I would like to add, I have great sympathy with what you just said around the enablers. Clearly something that we spend and dedicate a lot of time to as well. And I think I mentioned earlier, like copper miners, like First Quantum, or the semiconductor part of the industry. And there are also much more players along the value chain, like semiconductor equipment companies. They're all needed for this energy transition. But I think in your initial question, you highlighted what do we favor? Is it like wind, solar, hydrogen? Christoph. And look, what I will say though is, in order to hit the Paris goal to limit global warming to 1.5 degrees by 2050, we need all the solutions just highlighted. And if you think about generating investment returns, it very much depends where you are actually based in the world. There are obviously places that are naturally advantaged to use solar, others less so. And I think one of the very interesting points is that 40% of the world population lives within a 100-kilometer radius of the coast. So that's why offshore wind is a very attractive way. And this 40% includes India and mainland China. So just in the Western world, the share is much higher. And there, obviously, offshore wind parks are a very attractive way of generating electric power. So this is the one thing I would like to highlight. Perhaps from a continental European view, it is very vital also for developers to focus on both, on solar as well as wind, because in the summer months, there's obviously a huge opportunity to generate solar power. In the winter months, obviously less so. For wind, it's the inverse. The most electric power you generate with wind is from October to February. So blending those two actually gives you a very secure and stable energy supply. And this is what companies should focus on, like Equinor is doing it, for instance, and not just from a security perspective, also from an earnings perspective and from a return perspective. I think like an offshore wind park from a forward-look perspective probably yields you healthy returns of 4 to 8%. So I think these are very attractive areas going forward.
Thank you very much. Thank you, gentlemen, for these insights.
Of course.
Let me, before we open up to questions from the audience, let me maybe also challenge you now on the contribution that your investments have to the Sustainable Development Goals. One could argue that investing in listed equity basically means transferring ownership of shares from one investor to the other without any additional capital flowing into the industries that we are currently talking about, renewable energies and related. What would your response be to that, Kilian?
No, in that sense, first of all, you're right. And this is maybe coming from a different angle, the entire debate about divestment. If we decide to divest, we simply put on an order at the London Stock Exchange, we sell our shares, someone else picks it up. But the big risk here is that the new investor is maybe not as environmentally conscious. And I think the big contribution, coming back to your initial question, that we, deep fundamental, bottom-up investor can do is engagement and active ownership. I mentioned it earlier, we tend to be a significant shareholder. And with all those companies we've mentioned, we have regular one-on-one meetings with the CEO, with the CFO, and other key decision makers. And we ask them to walk us very clearly through their CapEx plans. And I think our mission and duty as responsible owner of the companies is to validate how realistic this plan is. Look, it's very easy for a CFO or CEO to present a beautiful plan until 2050. It's a very long time horizon, and if I present today a very beautiful plan, I probably keep or calm the society and maybe my investor base. So for us, the challenge is looking how realistic is the plan, taking it back to industry expert, comparing it to competitor companies, and assessing how realistic and achieving the achievement of a net zero 2050 goal is. And then we take it back, engage, and obviously want our voice to be heard. And the last call is obviously divestment. Again, it's less so about the transaction that we spoke about, but it's you send a social political signal if you divest. So this is maybe the one argument to it, but I think the engagement and active ownership is such a vital part. And the companies, this is the feedback we get if we speak with the management teams, they very much appreciate it. They very much appreciate what you, the asset owners, actually say, because you guys always come to me and ask me about new insights, about the plans of a net zero transition. And we take that back to the boardrooms when we speak with the CEOs, and they very much appreciate that. So we all can actually have an impact here. I'm a fundamental believer in that. That's why I'm a fundamental believer in deep fundamental bottom-up stock picking.
Thank you, Kilian. And maybe Michael, what is your view on creating impact as an investor in listed equity?
Well, I think first of all, very important what you mentioned. But for us, for the thematic side, that's certainly something which we do not follow because we don't have the resources. What we follow is certainly granting access to markets and trying to provide vehicles that can achieve an outperformance to the regular benchmarks which you have. But on the other side, what we also have is something very interesting. It's a fund I mentioned earlier. It's our Clean Tech Fund. And when you access the website of this Clean Tech Fund, you have an impact calculator. So you can basically insert the amount you're trying to invest, be it 10,000 or 1 million or whatsoever. And then you have different categories where you see what the impact of your investment is. For example, the reduction in CO2 emissions, the reduction in water consumptions, and all like this. So it's, I think, a very interesting tool, and if you have a minute, I really invite you to access this website. It's Clean Tech Fund.
Thank you, Michael. Aanand, what would you like to add?
Yeah, I kind of take your point there. Let's say if you're talking about Apple or Google, and if I'm just swapping 100,000 shares, I'm just kind of moving capital, right? So I'm not making any impact at all. But what we try to do is, within our funds, we have a significant exposure to small and mid caps. That's one, and in fact, with our larger funds, we end up being, in the top 10 holders, owners of individual companies, right? So that's one. The second most important thing is, working within a shop like Legal & General, we, as an asset management firm, we manage over $1.5 trillion, and that means we are able to engage with a multitude of companies through our dedicated investment stewardship team. So active engagement is of paramount importance to us. It is done independently through transparent policies where the head of investment stewardship does not report into investments but goes straight into CEOs, right? And LGIM, we've built a pretty consistent track record when it comes to that engagement by third-party rating agencies as well, where we've consistently ranked in the top end by someone like, say, Share Action. So that's one. That's the second part. The third part is that, you'd be surprised to know anytime we pull a stock out, pretty much in a rules-based manner, how actually those companies reach out to us and say, why have you done it? Because for them, a shop like LGIM owning a decent stake in their company is sort of a vote of confidence, right? So we believe in their business models, we believe in their strategy, and we hold about 3 to 5% of that company. And if we've ended up holding them for about 5 or 6 years, it is actually a vote of confidence. And we shouldn't underestimate the amount of fundraising ability that they would then have, particularly if you have anchor investors like some of the large asset managers behind them. But if you end up seeing that volatility in and out, and if you see 2 or 3 large managers pull out of those companies, straight away the confidence drops. And that, in our view, is again another dimension of adding impact in the listed space. Yeah.
Thank you very much. Now, please raise your hand if you have a question. And please also tell us to which panelist you would like to address this question in the first place.
Yeah, first of all, thank you very much for your quite interesting insights, how you're investing in renewable energy. And the question goes to all three of you, so you can choose whoever wants to answer. As I understood, you are investing in renewables through listed equity. So my question is, have you ever thought about investing in renewable energy through private markets? Because the background of my question is, you mentioned it, Kilian, when with a market run, for example, we see the drawdown, and which is a little bit paradox talking about renewables, of course, regarding the impact. So my question is, have you ever thought about private markets investing in renewable energy, and why not? What is the reason for it?
Yeah. Should I go?
Yes, please.
Yeah. We have, as a firm, yes. We can't do private companies in an ETF wrapper, but within our real assets team, we've got a JV with another firm called NTR. We've got Patrick, my colleague, who heads up the distribution here. He can tell you a lot about that until cows come home. But we've done that. And Legal in General, as such, we are one of the substantial investors in the world's largest offshore wind farm, which is being built in the North Sea of the coast of North England, right? So Hornsea project. So we have a significant stake there. And then we just closed the first round of fundraise with a JV with NTR to invest into some of these private areas. Yeah, absolutely. But it sits within a different team. Yeah.
Kilian, Michael, anything?
Yeah, sure. So we as a global equity team have not, we are doing the same strategy and applying the same investment philosophy for over 16 years. This is simply not the mandate that our clients have given us. They want exposure to listed equities, but I have very much sympathy, obviously, with your argument that you brought. There's huge opportunity as well in the private equity space. The thing is, you have to focus on different companies then. Again, it's not our mandate net what we do, but it's certainly a very attractive area of investment as well, certainly.
Yes, maybe Michael.
Yeah, quickly, I think that's something we discussed yesterday. It's very important. I think it's getting traction. It will be much bigger than it is today in a couple of years down the road, but it's nothing we are doing at the firm right now.
Yeah. And just one small thing I wanted to add. So we also got another division within the group called Legal and General Capital. So we've invested into sort of growth areas there, more for LGC's point of view. So we are a minor investor in one of the few fusion technologies, right? It's an Oxford-based company called Tokamak. So we have a stake there. We used to have stakes in Pod Points and many other new tech companies, some of which we've exited with multiples, very attractive multiples. But that's on the growth space. The NTR JV is more on the yield play. Yeah.
So yeah, first of all, thank you so much for all of you for your speech. My question is more like, now we know that to decarbonize aviation, we have several sustainable aviation fuel. So my question is how you make your decision by investing in, let's say, e-fuel or biofuel, or you invest in all of them, or you chose a specific technology?
Yeah, very happy to start this time. So I think it's an excellent question, not just for the aviation industry, but we also saw in the EU essentially banning traditional combustible engines, but still allowing biofuels or synthetic fuels. So how we do it, we are a deep fundamental investor, highlighted several times, only 26 stocks. So we would only invest into one of those companies. In the end, it's all about deploying capital and investing. It's all about opportunity cost. If I would pick multiple companies, I have less capital and therefore less conviction in the company I maybe like most. So we very clearly invest in the best ideas in our view. So we used to be a shareholder a while ago in Neste. I think I mentioned it earlier, the Finnish-based biofuel company. The reason why we don't have any biofuel companies at the moment, which might sound counterintuitive with regards to the EU legislation or also the aviation industry, the reason is too many companies are now trying to go into this area. Neste was operating in a very niche market. Now all the big oil and gas majors are jumping on sort of the renewable and synthetic fuel train, and this is obviously limiting your earnings potential and EPS potential for those companies. That's why we currently do not have any of these companies in our investment portfolio. However, it's obviously something of great importance for the long term for society, but from an investment return perspective, it is currently nothing we are looking at. And that's also the key question. Many of our investors, and I think you very kindly highlighted at the beginning, are large pension funds. So the retirements of people, and you can't retire on renewables or ideology, you can only retire on investment returns. So this is something we very clearly have to understand the trade-off, and the company has given us dramatic returns. It used to be a very strong performer, but we understand it's a wrong time from an investment perspective to go, and that too many companies are chasing the same thing, which is great for society because it will drive the cost down, it will give us more availability, but we currently don't like it from a return perspective. I hope that does answer your question.
I would say, I mean, just to add to that, I would say right now there are many technologies within aviation which are still in a technology demonstration phase, right? So where could the future of aviation be? Of course, biofuels, that's one. Hydrogen is another one. Battery-powered aircrafts is another one, right? But with battery-powered propeller-based aircrafts, you can't achieve the speeds of a jet engine, right? And now with jet engine, you need the fuel, or you're looking at hydrogen and so on. But even if you use hydrogen, you haven't solved the nitrogen oxide problem, right? The atmosphere is 70%, 80% nitrogen. So that is, again, a greenhouse gas. So the technology needs to evolve further. I think we are doing the right thing, where there's a lot of innovation happening. But then over the next 5 to 10 years, we'll see some of those, poorer technologies drop off, and the more sustainable, more, the winning technologies will end up shaping the next decade, right? But interestingly, one other thing to point out is aviation does get a lot of bad press, but for us, the lower hanging fruit is hydrogen. Mm-hmm. Today, producing gray hydrogen emits more CO2 than the entire aviation industry combined, right? So that is the elephant in the room, and we've got a solution there. So aviation, we're working on solutions. It could take another 10 years potentially, but with green hydrogen, we've got a solution today. We just need to kind of bridge the economics gap, right? And that's already happening. And when that transition happens, when the economics start stacking up, no one needs to incentivize someone to say, hey, go and produce green hydrogen. Because if that's the cheapest, hey, I would go and do it. Why would I worry about getting hydrogen from natural gas, right? So imagine you can already make a significant impact, more than the entire aviation industry combined, by just switching out of gray to green hydrogen. And then as that technology improves, shipping, do you use ammonia as a fuel? Probably yes. Again, you can cut down. Steel and cement manufacturing, far more CO2 than aviation. Can we switch them to hydrogen? Yes, but still in technology demonstration phase, right? Costs are not there yet. Economics is not stacking up. But once we do that, aviation is not going to be such a big problem in front of us, yeah.
Michael, would you like to add to that?
Can I quickly?
Please.
Well, look, the answer is quite simple from our point of view. So when we consider launching new thematic investments, we basically look at thematic purity, we look at long-term influence on society or technology impact, and these are certainly two boxes which can be ticked. But at the same time, we also need an investable universe. And when we talk about investable universe, we need to have a certain amount of listed companies which have an amount or a decent amount of revenues which is generated from this segment. And this is not yet the case. But as soon as we have it, and as soon as the market is evolving, then certainly that could be one of the solutions we could launch in the future, but not yet.
Thank you. Maybe one last question before we go back to the panelists for the closing remarks. If there's no question from the audience, then I would like to ask about undesired externalities, because we talk a lot about, the impact that we're looking for with our investments, but when we think of lithium batteries, when we think of other ways of storing energy, transporting energy, there's also undesired externalities in every activity that we invest in. So how do you measure that, and how do you basically make sure that the clients that want to invest in renewable energies are also aware of those?
Yeah, I mean, I can start on that. I mean, particularly if you take batteries leaking and things like that, right? I mean, the battery technology will continue to evolve, but one thing that humans are good at doing from a logic standpoint is applying inference and conclusion, right? So when you look at the way we have actually handled lead-acid batteries, lead is the most recycled metal today, right? I mean, particularly in Europe, almost 60% of lead that we get is recycled, right? We've mastered the art of recycling lead-acid batteries. Now, can we replicate that to lithium-ion batteries? Yes. Are we doing it now? No. What does it take to replicate it? We need more scale, right? I mean, we need more lithium-ion batteries. Right now, everything that you're putting into EVs are finding their way into second-life batteries for grid storage applications, and that would be another few years before all of that volume starts hitting the market, right? And the recycling technology will improve. I'm pretty confident about that, particularly if you look at what we've managed to achieve in lead-acid batteries. And I would go with that optimism, really, in that space. And also, lithium-ion batteries may not be the solution forever, right? And that's what we do within our fund. Lithium-ion today, it's the case. But sodium-ion batteries, we've started working on those over the last decade. Maybe that can take off, and that would have a much lesser footprint. Or it could be flow-based batteries, or it could be zinc air or lithium air batteries. So for us, the job is essentially to track developing trends and try to give our investors exposures to that, essentially, and not take sort of too early calls. But I would generally keep a fairly optimistic view there when it comes to, say, recycling and ensuring it's circular. Yeah.
Michael, what is your view on undesired externalities in an ESG context, maybe?
Yeah, I think for us it's all about storytelling and telling the investors what they actually get when they invest in a new thematic investment. So, for example, in January we launched, this is one of the most recent launches we have had, the so-called Future Minerals and Mining Index. We have received quite a lot of client interest over the last couple of months, so basically starting in 2022, that they see a different set of minerals and metals are required for all this energy transition, which is certainly going on. So we are talking about lithium, which is for the batteries. We see other things which are required for electronic hardware. We see things for electric vehicles and for solar and for wind, certainly. And here we talk, of course, with our clients about you basically invest in mining companies. But when you invest in mining companies, which is certainly not a sustainable business, but this is required in order to produce the solar panels, in order to produce electric vehicles, so on and so forth. So the clients need to be aware. At the same time, it's essential to driving this development further.
Thank you. Kilian.
Yeah, sure. And I perhaps would like just to follow up on the optimism in the battery world and perhaps battery and energy storage angle of the theme, because I very much agree with that. Look, historically, the big problem is always transporting renewable energies. If you're perhaps one of those 60% who don't live in close proximity to the coast. And we historically have done that via grids, but there are areas which are very difficult and very expensive to reach. So with battery storage, there are actually now companies focusing on, for instance, transporting renewable energy via ships. That was unthinkable a decade before, was only thinkable for actual commodities like oil and gas. So I think that could be a very interesting future opportunity for society, but also for us as investors. A second area, perhaps for externalities, that's worth addressing is the political landscape. We've seen a lot of acts around the world. In the US, for instance, the IRA, Inflation Reduction Act, which is everything but a Inflation Reduction Act. It would probably rather drive inflation up. It should rather be called a Green Act, $391 billion dedicated towards tax credits and subsidies. And this obviously changes competitive dynamics of industries and also companies, but also opens up for us great investment opportunities. And also in the EU, you've seen a similar comparable version.
Thank you.
Sure.
And maybe now from each of the panelists, a short closing remark with regards to where we are as an industry today. We have been talking about renewable energies for many decades now in an ESG context, today more in an SDG context. As an industry, where are we and where are we heading to? Maybe here, Michael, please.
Well, I think first of all, don't underestimate the power of the financial industry as a driver towards this Paris agreement, that we can, together with the industry, with the consumers, can reach the goals. And certainly, if you have interest in certain topics, I think invest where your heart goes, invest where your emotions are, and where you feel most confident.
Thank you, Michael. Kilian, your closing remark.
Sure. Well, look, the demand for renewable energy is clearly massive. The intentions around the world are clearly massive. The big question, though, is around the affordability and who is ultimately going to pay for it. Is it the end consumer? Is it the developer? Is it the manufacturer? And these are key questions for us as investors in order to make money, in order to play the theme correctly. This is the one area. The second point I would just like to touch on is around where we actually do business, because we only want to invest in regimes that are stable and predictable. And historically, this has just been a focus for emerging market countries. However, we did see last year some warning signs actually as well from some EU countries that put on windfall taxes on some of the energy companies. Equinor, for instance, have become the largest taxpayer in the world. It's an 86 billion market cap company. It's tiny compared to some of these large US companies, and yet it has been the largest taxpayers. And where we do have a certain degree of sympathy for that, because it's the idea of redistributing wealth to the society to help them in the cost of living crisis, again, we very much share and support this idea. It is still something we have to watch, and we have to be very careful and diligent of when making investment decisions. We only want to invest in regimes where contracts are being honored. And why is that important? Because when talking about renewables, these are all very long-term projects. It takes around 6 to 7 years to build a wind park. If we talk about net zero and the various steps towards it, 2030, 2040, 2050, the time horizons are so long. You will go through various political regimes. So this is something you have to pay close attention towards. And that brings me back to the point I made very earlier, to the sort of triangle of energy, security, affordability, and sustainability. Thank you very much indeed.
Thank you. Kilian, Aanand,
Well,
the last word is yours.
I would just say, in my view, we are probably at the most exciting phase of power and energy. I mean, if the last century was oil and gas, this century is renewables and clean tech. And I'm not saying this lightly, right? In fact, when you look at the way we've been producing power and energy, for the last 100 years, we've been using the wrong technology. I would even go that far and say, because the technology of wind turbines, batteries, and electrolyzers are older than the internal combustion engines, right? And thank God, over the last couple of decades, we've started investing into those. And you see that even within such a short time, we've managed to achieve economies of scale and exponential improvements in technology. So for me, as I look ahead into the next few decades, it is, I would say, the century for renewable energy that encompasses, clean power from wind, solar, hydrogen, and hydro and so on. At the same time, battery storage and users of those technologies, right? But the only caveat is that while we are adding a lot of capacity and we are hitting lots of records, we're not doing it fast enough. If we are building about 300 gigawatts of wind and solar a year, in my view, it should be 600. So the question is, where is all that money going? And our job is to try and identify companies and areas which is best positioned to attract that flow of capital. So I would say very, very exciting to be in this space. Yeah.
Thank you very much. So with these very encouraging words, we close the panel today, and I would like to thank the panelists for being with us today, and to all of you for your participation. Thank you.
Thank you very much.